Good Friday, 9:30 a.m. Pacific Standard Time, 4/6/2012. What do we have here? Well, we're going to show you. MMTs, you have an S&P 500 weekly index, and here it is now. And when we had this big, beautiful weekly breakout in that bull breakout movement, we kept making the highs up here on a weekly level. And that as we would be going through that original 2 to 4 week cycle pattern, and we started back over here on this week, and this ended week 3. Now, let me tell you what, the 4th week is going to start on Monday. And down here below, this is a standard application back there. That doesn't make you money, but this daily S&P 500 MMT chart does, because it's got the diamonds in it. Now, here's that great rally, and we're going to go back 5 days. 1 day, 2 day, 3 day, 4 day, 5 days, right here. And what does that do? That equals this weekly movement. And that when you would get to the top, that my April forecast before April started, and today's 4/6/2012, is that price volatility would increase 90 days increasement in price volatility in bull market exhaustions. And when the bull is trading, rather it's high frequency computing models that's in the tape these days, things that you don't know about, is when turns are going to happen, they're going to happen at certain mathematical ratio, both on the reversal side, which is 3 days right here, and how that delta on the daily, on the S&P, shot right up there to our price. And the kiss goodbye started right here. Notice that that diamond close was below that high diamond right there. Yes, it was. And then now, look at where we're at. Now, when we started talking about the price patterns, if I go back, here's that 5 days. Now, look at the previous 5 days. MMT, 1 day, 2 day, 3 day. Here's the 4th day. And here's that last 5-day pattern. So when you were down here at this lower breakout level and reversals, as I said, price volatility represents a 1 teeny, 2 teeny mathematical script, and this is not a teeny. Actually, each one of these lines are $9.50, each one of them on the S&P. And so, yes, they have their delta ranges in our system, because they do. What I will tell my MMTs is that the price volatility, if you look, 3-day reversal, 3-day reversal. Look at now, these are actual live trading days. That's 5. It starts over here. There's 3, there's 4, there's 5. Right down here at that delta line at the high, that's called a runaway gap up. Bam. But we were increasing, and at each high, we would reverse, hit that support, make that blow off top that we always talk about, but then those reversals are going 1, 2, and 3. It's in a 3 at $9.50 times 3 half delta movements, MMTs. All right, so that's the part that you want to know about. And you can see when we said that price volatility would increase for the next 90 days, this is how it looks like, MMT, at bull market tops on the S&P, and this is the SMF MMT platform at $9.50 per line, and that's how it's going to trade on Monday, because it will. And so each half delta line represents either a resistance up here, half delta, reversal, and the script, the mathematical script, is 1, 2, and 3. Well, if you do $3 times $9, that's 27. And if you add on the 50 cents, well, that's $1.50 more, and it's $9.50 on the S&P. and that's a half a delta movement. Of course, you'll have shorter time frames, but we're talking about price exhaustion and price volatility will be increasing. It'll be harder for the average retail trader to adapt to the bull side reversal. And it happens all the time. But our MMTs, the first place that you're going to be looking at is that we're going to gap down on Monday. And this half bar is 1385 right here. And that half bar was on 313 of 2012. And that's the half bar. Now, when we start looking at where that delta retracement's going to be, we can see that big rally that started right over here when it cleared that half bar right here. And we got, and the call side paid big money. Yes, it did. Then you faded back. But each time you made the higher high, you start to see more reversals up here. And that's what you've been taught, is that each new high has that reversal trade that you make money on. And then the bull pops. And it goes in the same mathematical formula that we build. And we do build custom applications for people starting at 50,000 plus. So if you're looking for that kind of solution, info@stockmarketfunding.com. Now, having said all of that, the weekly pattern in this chart is when we were calling the top back on, we were talking about standard technical analysis, but our platform was built different. However, you were overbought at 97%. Then you went to 95, and then 94, and then to 91. And you've worked the overbought process off on the weekly chart, and you're still in a very, very tight bull move. But come Monday, the S&P 500, we're going to see if the S&P 500, where our target to buy the dip is going to be down here on this weekly chart. That's what we would like. Now, these are weekly moving averages. We're not going to just come barreling through here. I'm not saying that. But what I am saying is it's going to be our first level of test in this weekly bar breakout right there at that 10-week. And that the broader market is working the overbought bull level capacity off, meaning that once it works it downward, has to pull back. And when it pulls back, you can get paid for the pullback. And as you can see, the price exhaustion on the weekly, it's still overbought at 91.65 in their world. Okay, so the actual pattern though of the S&P MMT is this right here, and it's all about the trade management. So when we rally up long here, and the put side of the market, I'm just barreling in on put options because they're cheap up here where the reversal is. And that's where the money is made, MMT. Oh, yes, it is. And then when it's time to get net long, and these are the daily patterns. But notice that each high, you go back in the 10-day pattern on the daily MMT, you can see the pattern here. But you can always see where that bull pops the same way. And he will pop again. So on Monday, we're going to be looking to see if we could get the S&P 500. I will be giving some prices. And the prices that I'm going to be given, we're going to see if we can get down to 1360 on the S&P on Monday. And another part of it that we're going to be doing, here, I'll just show this highlight right here. This part, this top reversal is, these are going to be the delta line supports. So 2 deltas is 1360. I'm going to be looking at a 2.5 delta hook at 1350 on the lower end of that. That's 46 handles from here that the S&P would have to fall to hit that 2.5 delta mark. Now we'll be looking for the gap down on Monday below 1379 on the S&P as 1 delta down. That will be 18 handles lower than Friday's or Thursday's close. Today is Friday, but markets are closed. So we're going to be looking at those delta ranges. Now, having said that, we will be doing the calls and the puts in the S&P 500. for the MMTs that are not here, that are doing other things today, this is going to be where we're going to take the closing bell of 1398.08. That's the last print. And we're going to be gapping down. We're going to be doing this weekly called S&P 500 Index. I'm not going to make this particular one too long for you, MMT, but I will tell you right now, I'm going to be looking at how to pick off that lower end of that support level. So if I'm gapping down here, MMT, on the daily platform that we have, if I'm coming all the way down here and I can test where this breakout was, that means that these in the money calls are going to lose their value, and I will steal that wholesale bid from them, and I will get that lower dollar risk entry better than anyone else out there on the market. And if you'd like to join us for 5 days, I'll prove it to you. All right? So that way we can just clear it up that way, okay? So we're going to be looking at the call and the put side structure, and we're going to be doing the weeklies, and we're going to be doing the monthlies, and we're even going to be looking out further than that. But short term, because each time we would be looking at where that bounce is going to be down here, and I already gave you some numbers. And Monday morning, you're going to be gapping down in the S&P 500, because this is what we call an exhaustion high here and a reversal in our platform. And it's got it all mathematically coded as to where past behaviors, these behaviors over here in the bull cycle will occur. And our goal is to get us wholesale on the long side of these calls that were totally inflated. And we'll do that in the next video, because we will be trading these weeklies and these monthlies in our S&P 500 index options training. As a market maker, though, not a day trader, not what you've done in other books and CDs that you've seen. No, different way of doing things here. So MMT, I'm going to be looking at how to steal these bids. In the next video, MMTs, I will be going through them wholesale bids and markdowns, both on weekly and monthly. Same thing on that put side, and how this coming Monday, today is 4/6/2012, and this is the S&P update for the MMTs that are not present. And this is the daily MMT platform based on 5-day patterns and 10-day patterns, and how bull exhaustions have reversals, how you bounce at support and sell back at higher highs at resistance. Price volatility increases for the next 90 days. And the price volatility increase means that you get the long side, but you also get the short side of the bull. And you get those daily pullbacks and bull rallies. These are normal, and you want to buy, you want to get short up at the high reversal, and you want to buy the dips, and you just want to, once again, making that market. But the patterns, the behavior patterns with the public are clearly marked. And each time that you hit this lower, you went down 1, 2 in the script. So that was $19 reversal, but look at how accurate our diamonds are. And we closed up to the high. We took out that reversal. It was time to be long, and you got that boom. And you got right up to an exhaustion high, and then the counter rally exhaustion high. But look at the patterns. So each time you made those highs, even over here when you were first making highs, you were pulling back, but look at, they were great longs. So right now in the bull rally, going into earnings season, you're gapping down Monday on the S&P 500. You're going to have a gap down on Monday. I'm putting it out here now on Friday. Yes, I am. And today's date, 4/6/2012. I'm putting a high alert to my MMTs that we want to be stealing the bid and getting as wholesale. And I will give you an example. I will throw a 1360 call right here on a weekly level, which there isn't much because it's just a weekly, so you're not going to see it on that print. I will use the monthly 1360 right here. And what I'm talking about is that on the weekly level up here, as you are taught, that I was on the other side of the market because, yes, the weekly 1360 call had got totally price inflated. Yes, it did. Not only did it, look, you can see. And what happens that this inflated price has to come back down. And yes, MMTs, we will get a chance to buy the wholesale prices. Remember, when we were going long a long time ago, they were cheap. They went from, this was a longer term play, but this is the S&P, and it's a 1360 call that's inflated and has to come down. So right now, MMT, as part of your assignment, is that you're getting awfully wholesale because these calls were inflated, and you are taught by me specifically how to get net short. And the high of that call was $63, and it was on 4/1 during that week starting. That's the high. And the low right now that we have is going to be $41. And that's what happens when people don't sell at the high. They lose all of that premium. And this is on a weekly level. And we are going to steal the lower bids. And I'm going to let it be known before the fact. And yes, we are going into an earnings season. But so what? The bull got too inflated in the call side of the market. And that meant that the put side of the market for the last 3 weeks in our analysis was that you were going to put a topping pattern in, and then you would have to have a good put side reversal because the calls have got to come down in value to shake out all the buyer here on the S&P 500. Now that call's deep in the money. And not only that, we'll be looking at ones like this as well. The shorter term one will be the 1375 call. Look at that. They got too inflated, as you are taught. Look at, we're going to buy wholesale at where that S&P 500 hit support level. MMTs, yes, we are. And what does that mean? That means that our platform right here, most of you never seen a call chart before. Let's be honest. It's okay. This is going to be wholesale for us, and we're going to own it. And when we do own it wholesale, that is the time we're going to apply that volume to that trade too, because you're going to gap down. And these calls are going to come down to my wholesale entry, and I'm going to be the cheapest one on the street that owns them. And then they're going to bounce, and I'm going to sell them back to the public. And that's what I'm going to do. And why? Because it's going to be based on this gap down, which will be a left elbow gap down on Monday. Remember, this is Friday. So Monday you get that gap down and you hit that lower support level or sell down to it. That's going to strip all the value out of that 1375 monthly call. And guess what? It's going to bring it right down here where I want to own it. And I know how to do it. But they were inflated. And that's the 1375. And that the put side would go higher. And the puts pay again on Monday. Believe it. And that's why I'm putting it out on the S&P. And we're rocking. Here is the $1,400 put that was deflated, that we were just enjoying the purchasing, buying this deflated weekly put on the S&P 1400. It's going to go back up in value. It was marked all the way down from $71 to our wholesale entry. And that there's the $1,400 put that gaps up on Monday and pays. And we'll sell it. And we'll buy, once again, we'll go back to that 1375 when this 1375 gets down. So when this comes down to the bottom, I'll be buying that and I'll be selling that put and I'll be ringing that cash register that way. And I'll enjoy it too. Because when my rent is due, it's always due at that wholesale bid. And that means that when I'm making markets down here, I've taken all the dollar capital risk out. If I'm buying 30 contracts at 20, at $60,000. If I was buying 30 contracts up here at $50, that's $150,000. Now you can add it up. So if I'm buying 10 contracts down here at $20, I'm saving $30,000 on my purchase, and when they pop back up to 35, I'm making 15,000. That's what we do here. That's what we believe in. We believe that inflated values must come down. Why? That $1,400 put is paying us money because right here we bought it wholesale. And when it pops up here, well, then I shall sell thy into the strength for my profits. S&P 500 weekly analysis, weekly chart. S&P 500, it will be gapping down, and it will gap down using this platform. We're looking for these lower delta ranges. We'll be looking for right across here at this delta, right below that 1372. Just remember that the last print was 1398, and that the 3-day reversal, 3-day reversal, 3-day reversal, making the exhaustion highs, and it's been a very nice bull. And buying that dip at that wholesale bid and selling it back to the public is your best interest, and it is for your well-being.